Hello, and welcome to the Conference Club of the French American Chamber of Commerce. Tonight we have the pleasure to have Patrick, who will talk about cross-border wealth and tax optimization. So just a few words before I give the mic to my good friend. So the Finance Club, you have two co-chairs, Nicolas here from Lactalis and myself. We organize usually 3 meetings per year, talking around tax, finance. So this year, the next topics will be around the private equity investment, and there will be another one around AI use for CFO. There's also a joint club March 19 with the supply chain club around tariffs. So we try to be to date with everything, all the breaking news. We will also, I don't know if you have a paper, but we also want to launch the WhatsApp app for all the members. So when you have questions on this kind of things, we will try to update you and give you some news. What else? For those who are not member of the chamber, obviously you can join. You can become a member, individual member, SME member, or large corporate member. Stephanie and Delphine can answer to all your questions right after. So, no, Patrick, the floor is yours. And we will take a question after. We already received question, I think.
Some.
Yes, some questions, and we will take questions right after. Oh yes, and I forget to say something. We really want to thank the Lycée Français for this tonight. It's we usually all our events are at the Willis Tower, so this time we are very happy to be here at the Lycée, to be close to the French community.
Merci Vincent. Bonsoir à tous. Thank you for coming. I'm very happy to see these people tonight. Thank you for Delphine, the chamber, to invite me. Thank you to the Lycée for hosting me. First, could you please take on out to scan the QR code? This is to see the slide. I'm going to go pretty fast on most of them. So if you have it in your phone, that may be helpful. And during the presentation, you also have the QR code on each side of the room. My passion for investment started very early, as you can see on slide 3 on the top left. I was 1 year old. I was already playing with a bill, a French franc bill. A few years later, at 7 years old, on the top right, my grandfather gave me a $2 bill for Christmas. And I started to go to the bank, to the Caisse d'Épargne, every day to check the value of this $2 in French francs. So that's how it started. And now I've been helping people with financial decisions for 25 years. Next slide. This time I decided, because images are worth 1,000 words, so you're going to see more images than before. So we'll see many cartoons like that. Next, in terms of agenda, I'll start with a summary of what we're going to talk about tonight, why this is important. We'll talk about inflation, retirement, diversification, stocks, cross-border financial planning, taxes, and some specific issues for expatriates. So in summary, you should stick with your financial plan. You should stay invested. Markets go up and down, so there's lots of emotion with your plan. Do not try to time the market. It does not really work. Don't panic. Review your portfolio annually. It should be globally diversified. Avoid double taxation. Make sure you file the correct tax forms. If you want more information about decision making, you can look at this URL at the bottom. On slide 8, I put some quotes. I like to start with some quotes. I will just read the first one from Warren Buffett. We simply attempt to be fearful when others are greedy, and be greedy when others are fearful. And I like Buffett so much, I put another slide just with Buffett quotes. We have another 6 on slide now. I'm not going to read them, except the first one. Let's say an idiot with a plan can beat a genius without a plan. Next, you see the type of words I will be using tonight. That's a summary. The typical mistakes on the next slide for cross-border financial planning are about tax misunderstandings, currency risk, retirement planning, and foreign assets. So you should diversify your investment, have a strategy for currency to have a good tax plan. Next, why this is important? You want financial security, you want to achieve your dreams, you want peace of mind. One of the issues people have is they don't realize that retirement can be very long. On the next slide, we're going to see some statistics about that. Slide 14. Oops. If today you are a couple at 65 years old, what is the probability that one of the two in this couple may live until 95 years old? People don't realize that the probability is high. And in this case, if you are a healthy American couple, one of them may live until 95, so 30 years in retirement. There is a 43% chance of that. And many of you in the room are French. French life expectancy is like 4 years longer than American, so this probability is even higher for French people. Next, another issue is inflation. Well, I put like 3 slides about inflation, lots of data, but the idea is, you see the stamp, what is inflation? A stamp that was maybe 6 cents in 1968, today you pay 78 cents. Look at the cost of college, look at the cost of bread. You look on the top right, you see this chart is since 1978 until year 2015. And you see that in red, college tuition and fees went up by 12 times. Since 1978 until 2015. If you look at medical care, it went up by 7 times. The next slide, you see inflation just for the last 25 years. Hospital services went up by 4 times. College tuition fees by 3 times. Childcare by 3 times. But TV went down by 98%. Inflation does not affect goods the same way. Next, on slide 17, just look at the last 5 years. The price of coffee went up by 2 times, eggs almost 2 times. So we have had quite a bit of inflation 3-4 years ago, especially. On slide 18, you see in blue how economists see inflation. And right now, the last few years, they say that there is not too much inflation because inflation is between 2 and 3%. But when you ask people, this is what they see in green. For the last 5 years, the typical American has seen a price increase by 27%. Another issue in the US, the cost of healthcare. You see that in the US, the price per day for a hospital is much higher than many other countries. That was in 2012, it's much higher per day. The next slide, you see that the cost of healthcare for a couple right now during retirement, maybe $350,000. You see the price of per year of a typical family for the last 20 years. It started around $12,000 and in 2025, $35,000. Another issue is on slide 21, the capital needed to retire. So if you want to spend $100,000 at retirement, adjusted for inflation, which means $100,000 the first year, 103 the second year, 106 the third year. How much do you need to retire? You look at this table, and for example, if you are 60 years old and you want to spend this $100,000 per year, you look at the magic number and you divide 100,000 by the magic number 3.2%. That will give you the capital required to retire. Those numbers on the table are wrong, but they're not terribly wrong. Now, plus or minus, let's say, 0.5%. And of course, the older you are, the more you can spend because your retirement will be shorter because you save more. And if someone say, I don't need 100,000, I just need $40,000, maybe I'm 30 years old, remember that $40,000 today, in 30 years, you will need 100,000 for the same spending. So if you spend $40,000 today, in 30 years, you may need $3 million to have the same spending as today. On slide 22, we'll spend more time on the next 4 slides. I went pretty fast. But this is what ChatGPT could do for you. I gave you a prompt. So let's see what I said. If you are 55, so let's say I'm 55 years old, I have $1 million in retirement assets. I don't know if I'm going to save $30,000, $50,000, $70,000 per year. I want to see what is the impact of changing my savings rate on an annual basis. And maybe I want $30,000, $60,000, or $120,000 per year for retirement, inflation adjusted. When can I retire if I may live until 95 years old? That's the question we ask ChatGPT or other AI. And you ask those tools, run 10,000 Monte Carlo simulation with 50 or 80% confidence level, so that you have 2 types of answer. 80% is more conservative. And you don't know if the portfolio are going to give you 4, 5, 6%. Can assume inflation around 3%. And you click on run, you wait a little bit, and we're going to see the result in the next slide. What do we see? The first table on the top is we assume 4% portfolio return, 80% chance of success. So we want to be more conservative. Most likely you can make more than 4%, and maybe you don't need 80% chance of success. You can adjust your spending during retirement if 1 year or 2 are bad. But let's see what it says. On the top left, if you save $30,000 per year while you are working, and if you want to spend $30,000 per year at retirement, the answer is 63 years old. But maybe you want to spend $120,000 per year on the right column. If you only save $30,000 per year and you want to spend $120,000, you may have to retire at 83 years old. That's assuming you have $1 million at the beginning, and that's assuming you have no legacy goal. You die with 0. It does not assume you want to leave anything to keep. So you may not be happy to retire at 83. So you look at other tables. You may say, oh, fine, I'm going to save $70,000 per year, and I'm going to spend $60,000 per year at retirement. So in this case, see, it's 69 years old. Since you may not like this table, you can look at the second one and say, fine, my portfolio is going to do 6% return, and 50% chance of success is good enough for me. And in this case, you see the difference. You may retire at 55 years old now if you want to spend only $30,000 per year. Another question I've had quite a bit over the years is, on the next slide, how much can I spend at retirement? So it's another way to ask ChatGPT similar questions. So same, I'm 55, I have $1 million, I save $30,000, $50,000, $70,000 per year. I want to retire at 60, 65 or 70, but how much can I get if I retire at those age? time, I'm going to die at 95 years old, run 10,000 simulations. Let's look at the result on page 25. Let's go slow, you have lots of numbers here. Top left, you see 4% return in the portfolio, 80% confidence, which means this table is more conservative. And what you see in the top left, if we save $30,000 per year and we want to retire at 60, it's okay to retire at 60, but you may only be able to take $25,000 per year for the rest of your life, inflation adjusted. But if you retire at 70 years old now, you could spend $43,000. If you save $70,000 per year and retire at 60, you can take $30,000 out of your portfolio every year. But if you retire at 70, you can take 2 times more. That gives you an idea about the sensitivity about when you retire and also using different savings rates. The bottom table is the same, but it's a 6% return and 50% confidence. So in this case, if you save $70,000 per year and you retire at 70 years old, you may be able to spend $135,000, much more. On the right side, we want to know a percentage. How much can I take out of my portfolio every year during retirement? So not an amount, we want a percentage. In this case, if you retire at 60, you see you could take out 2.25%, but if you retire at 70, maybe you can take out 3.2%. And if your portfolio does 6% per year, on the bottom right, and a 50% confidence level, you see those percentage could be 4 or 5%. Next slide, 26. Another issue is taxes. We're not going to talk about all the taxes, but one tax people don't understand is when you invest in the US in a mutual fund, in a brokerage account, which is taxable, you may invest in this fund, PIMCO, and that's here, the pre-tax return was 7%. So if you invested $100, you may have $107 at the end of the year. You made 7%. What people don't understand is because it's a brokerage account, the tax adjusted return, you're going to receive a 1099 form that you received maybe a few weeks ago. The 1099 is going to take money out of your brokerage account. And in this case, it's a big, I took an extreme scenario, but for this fund, the impact was $20. So you made $7. You didn't even sell the mutual fund. You keep it. You don't have capital gains, but the mutual fund generated taxes, and in this case, it generated $20 of tax. So the tax adjusted return is minus 13%. So you have to pay attention when you invest in the US, when you invest in mutual fund. Next, on page 27, it's easy, but if you invest at 0% in a checking account, $10,000 per year for 30 years, maybe you save $300,000 30 years. But if you invest at 8%, you see that your portfolio will go higher faster. In this case, the impact is 4 times higher. You invest at a rate instead of 0, going at 8%. Another issue is the traditional investor. When you look at the performance, in this case, it's a study from JP Morgan between 1999 and 2019. The typical investor portfolios was at 1.9%, which is pretty far away from a diversified portfolio where you see a 60-40 or 40-60. It means how much stocks you have in the portfolio, 60% or 40% stocks and the rest in bonds. But you see that the performance of a diversified portfolio could be 5-6% compared to the average investor. That makes a big difference. As you can see at the bottom left in terms of number, say $100,000 after 20 years at 1.9%, you have $145,000. You made 45%. But if you had invested in a diversified portfolio, your performance was 5.6. In this case, your portfolio would have tripled from $100,000 to $300,000. On slide 29, I wanted to show the impact when you improve your portfolio performance by 1%. Here, you see that you start with zero, you are 25 years old, you make $40,000 per year, you're going to have a 3% increase in salary, you're going to save 10% of your salary every year, you're going to retire at 65. And what we see is, if we invest at 5.5%, your portfolio is going to grow up to $900,000. That's a great picture on the right. But if you invest at more than 5.5, if you invest at 6.5%, you see you're going to have, of course, more when you retire. In this case, it's $200,000 more. The main idea of the slide is when you retire, you see that your portfolio may be depleted by 85 years old. But if you had invested at 1% more, because to do better investment, pay less tax, whatever, your portfolio could have lasted 12 years more. Now, another idea is the cost of procrastination. The idea is don't wait 60 years old to save for retirement. Slide 31, you see that if you want to have this $1 million we talked about before, if you invest at 6.5%, if you start at 20 years old, you only need to save $300 per month for the rest of your life until you retire. But if you stay at 55 years old, you have to save now $6,000 per month. So don't wait too long. Same idea about the impact of waiting when you invest. On slide 32. The first person here is the green line with the black dots. If you start at year zero for 10 years, you save $10,000 per year. So you save $100,000 total for these 10 years. And then you stop saving. You let the portfolio grow. Maybe this portfolio will grow by, after 30 years, to $700,000. But someone who starts 10 years after you and saves $10,000 per year for 20 years, so he saves $200,000 versus $100,000 from the first person. This person only reached $500,000. So you could have had 47% more by saving half of what you would have done otherwise. Another idea is market timing. So I don't believe in market timing. Works sometimes, sometimes not. So at the end, long term, it's not a good idea. Let's look at some data on slide 34. You see on the top right, a study between 1983 and 2008. So 25 years of investment with two terrible years in 2001 and 2008. The market was down 50% both times. But what you see is if you have just bought the Dow Jones, you buy a fund, an ETF, and you stay fully invested, after 25 years, your $10,000 would have become $170,000. But the message of the slide is if you miss 10 days out of those 25 years, out of 5,000 days of trading, you miss just 10 less days, your portfolio will have been only $100,000. And you have no ideas. When are the top 10 days? Some days are very good, you just don't know. If you miss 20 days, you only have, let's say, 70,000. If you miss 40 days, you only have 30,000. So the impact is huge. Another study is on the left. You see that if you invest in the S&P 500 for 20 years from year 2000 to year 2020, same idea. You see that if you miss 5 days, 10 days, you can lose everything. If you miss 20 days out of those 20 years, you lose. Your $10,000 go down. And you just have no idea when are those top days. If you want more about this topic, there is a newsletter at the bottom here of the URL. On page 35, Same idea about market timing, but it's by decade. So whatever decade you look at, you see that the returns of the decade could have been good, but if you miss the top 10 days of those 10 years, each decade, you see the impact on the performance. It's huge. It's not something new. It always happens. Now we're going to talk about asset allocation and diversification. So portfolio diversification is key to success. Page 37. Diversification is investing in different asset classes, stocks, bonds, etc. Page 38, you see diversification is the equivalent of eating vegetables. It's an admission that you cannot predict the future, and therefore you should not bet your entire retirement on one exciting stock tip from a cuisine. Like every healthy habits, diversification works only if you stubbornly keep doing it long after it stops being fun. We have many French people in the room, so the next slide is about wine and cheese. But diversification is like good cheese and wine pairing. You will not serve only cheese. Probably you should not serve only wine, but together can be balanced and enjoyable. That's diversification. Let's go back to some numbers. Oops. Go back. Let's go to 41. The idea of slide 41 is every, in this case, 5 years, you have different asset class that may do better or worse. For example, for the full period in orange, on the right side, you see that the S&P 500 was the best between 1995 and 2025 for 30 years. But if we look at the year 2000 to 2005 or 2005 to 2010, the S&P was terrible. That was 10 years where the S&P went down. So you want to diversify. If you go back to the slides you can download on slide 40, you will see that the diversified portfolio has a performance quite good over time. On slide 42, I show the impact of, instead of investing in one fund at 6% in portfolio A, if you have $100,000, you invest at 6%, after 30 years, you may have $500,000. But what I'm saying, you should diversify. Don't buy only one fund. Let's buy 5 funds, 20,000 in each, and you have no idea which one will be good or bad. Maybe the first one you buy, the $20,000 at 0%, they give you 20,000 after 30 years. That was a bad call. Maybe you have a fund at 4, at 6, at 8, at 12%. The average is 6% of those 5 funds. But if you can find one fund that has a good rate of return, in this case 12%, this fund may become $600,000. So you could have much more. You see, instead of 500,000, almost double by just diversification. And just in case you don't believe in diversification yet, I did another slide to show that since 1926, every time in blue, the S&P 500 US stocks was down, and it can be down quite a bit, as you can see. Almost every time, bonds, which are in orange, went up. So it's good to have bonds in a portfolio too. On slide 44, lots of numbers again. Let's go slow. Year 1, you have 2 funds, a portfolio, 60% in fund A, 40% in fund B. The return is 6% for one, 4% for the other. Total, you made 5.2%. You rebalance in year 2, you have your 60-40 portfolio again. It's a bad year, they are going down 10 and 5. Year 3, good year, they're going up 5%. At the end, this portfolio over 3 years was up 1.6%. But what I want to show is, if we add a fund C, which is guaranteed to go down, which you believe it may not be a good idea to buy a fund that goes down, because it will affect your portfolio negatively. In fact, depending on the pattern, depending how correlated is the stocks with the other funds, you can see that this fund was down 3.5%, but the annual performance of the portfolio is up 2.5%. So by adding a fund with negative return, the portfolio return was higher. Another idea now is to talk about insurance. Yeah, many insurance agents in the US, but many people don't understand what they are talking about. There are many bad products. There are lots of commissions in those products, and they are very good salespeople. But let's look at an example. Someone who is 44 years old, on slide 45. If the person gives $5,000 per year, that's a premium. What you have to look at in those documents is called the cash surrender value, the cash value at the end of the year, how much you can have if you close the account. In this case, after 1 year, you give them 5,000, you only have 1,500. After 2 years, your account goes up to 4,000, 8,000. After 10 years, you give them $50,000, but you only have $42,000 in your account. That's what is guaranteed. But they're going to show you some hypothetical, non-guaranteed. And even if you look at the non-guaranteed returns, the numbers don't look so great. After 10 years, you recover your investment. Sometimes it takes 6 years, sometimes 10, depends on your health, depends on your age. But I'm not saying it's always bad. I'm saying you have to be careful with, I've seen many people who are not happy with insurance products. You don't have to believe me. We can ask ChatGPT what they think about life insurance for French people. And this is what ChatGPT said 2 weeks ago. It's inefficient. If you leave the US, it may not be as easy to use a policy as an investment, low expected return. And your policy is in dollars. Imagine you need euros to buy your French wine and cheese in France. But if the euro is up 50%, and you have this insurance product in USD that does not generate much return and the dollar is down, you're not going to have much left. Now we go to slide 47 for an introduction about stocks. So slide 48, you see the stocks performance on the left by decades. And you see typically it's green. Typically stocks do go up over 10 years. But in the 30s, you had the Great Depression. In the 2000s, you had 2 bad recessions. They went down. But typically, you see the numbers look quite good. And then you can see the performance of the other, like bonds, will be much less volatile. On slide 49, you can see if you had invested $1 in year 900, 120 years ago, just in US stocks, you see that you could have had today $58,000. So stocks do work well on the long term. If you had invested only in bonds, you would have had only $300. That's a huge difference. But now that you become expert on inflation, you may say, what's the true value of this dollar inflation adjusted? So you look at the chart on the right, who's looking in real terms. So adjusted for inflation, your $1 did go up to $2,000. Still a huge increase. On slide 50, I show the performance of the stock market over 17 years average performance, the compound annual growth rate since 1939, which means if you look at the first data point in 1939, maybe minus 1%, it means that the prior 17 years, the stock market did go down 1% per year. If you look in year 2009, the last data point, maybe it went up by 3% per year. So that's inflation. So inflation could be high, like you have periods in the 70s, 80s, around 7% on average. Could be high like in year 2022, 2023. But the point of this slide is what I wrote at the bottom. US stocks have exceeded inflation during every rolling 20-year period since 1926. That's a good news. You beat inflation. If you buy bonds, you see 16 times out of 64 periods, you underperform inflation. But the problem of stocks on slide 51 is that they can go down. And if you look since 1926, over any 1 year period, you had a 26% chance that stocks were down. If you look over 5 years, you have a 12% chance. But if you invest over 15 years, you see 0%. So over the long term, the probability you lose in stocks is very low. The problem with stocks is the volatility on slide 52. This is not the daily or annual volatility. This is an annual returns over 10 years. So the last data point in 2019, you see 13%. 13% was the performance for the previous 10 years. So from year 2010 to year 2019, the performance was 13%. It was a great period to invest. But if we look at the point in year 2009, you see it was negative 2 or 3% per year for the previous 10 years. So even if you invest over 10 years in stocks, you could have big difference in performance. The next 10 years may not be very good. The past 10 years were very good. The past 15 years was very good. Since I opened BFM in 2009, since March 2009, the stock market is up like 12 times. It's more than 15% per year. So you should not expect that again in the next 10 or 15 years. On slide 53 is what happened when the stock market goes down. And you can see in year 2000, the purple line on the right, it was 2 very bad years. Stock market was down 50% over 600 days. In 2007, it went down even more, 55% over 350 days. So you see stock market can go down quite a bit. And this is a table as of March 2020, exactly March 23, 2020, which was the bottom of the impact of COVID. After 6 weeks, the stock market was down 35%. So you see the number of days when COVID really had a huge impact very fast. But then, if you look at the following like year and a half, you double your money if you had kept your money in stuff. Slide 54 show you those rebound. In blue, you see the bull markets. And you can see a bull market could be like 500%. It could be a small bull market, 60%. The last I just told you, since 2009, the bull market, it's like up 1,100%, 1,200%. We don't take into account those little downturn here. But I like this chart to show you that, yes, market goes down, it could go down again, it could be bad, but after you have those nice blue runs. Page 55 illustrates this kind of rebound. It looks at, as of year 2020, as of the end of March 2020, anytime the S&P US stocks were down more than 20%, so it can go down 10, 20, 30, 40, 50%. You see, it tends to rebound pretty fast. Within a year, 2 years, 3 years, you recover, but you should not panic. Now let's change topic. Let's talk about tax and the issues for expatriates. So even a Supreme Court justice would say on the right, for my tax evasion, I should be punished. For my tax avoidance, I should be commended. So let's talk more about taxes and try to be more informed about this. The typical issues I've seen. So we're on slide 58. On the top left, the French in the US tend to forget to file those forms. FBAR is the FinCEN 113. FATCA is 8938. You have PFIC. PFIC is FBAR and FATCA is when you have an account outside the US. Even if it's not under your name, if you have a power of attorney, for example, you need to still file the FBAR. The PFIC form, the 8621, is when you have investment. So you own a mutual fund in France, you own an ETF, you own an unité de compte in an assurance vie account, you need to file the BFIC form. SCE is when you own your real estate in France inside an LLC equivalent, when you own it inside a corporation. You have to file forms for the SCE, like 5471, 8865. So it depends on how is your SCE. Well, that's a big issue that I've seen. Another issue is education planning. When you have kids, it can be very expensive. Another issue is the asset allocation or the location of those funds. Even if you have the right asset allocation, you have to decide where do you put your bonds and your stocks because the tax will impact differently. Another issue is currency risk, or the issue is donation, succession. You have to report those. If you don't report, you have big penalties in the US. So if you want to learn a lot about those issues, you can look at the bottom, the URL. Slide 59 is about a new tax reform that happened last year on July 4th, 2025, called OBBBA. The main impact for you to remember is it's a permanent extension of some of those 2017 tax cuts. We didn't have this act in July last year, your taxes would have gone up quite a bit. Another positive thing that affect you, there are many things, but this one, the sort of state and local tax, the last 6 years, maybe it was only $10,000 per year that you could deduct from your income, from your state and local tax. Now it went up to 40,000. It's only for a few years, but it's potentially affect your tax quite a bit. Another impact is that they keep the federal estate and gift tax exemption to 15 million. That's at the federal level. At the state level, it's very different. 5 to 9 accounts for kids. Now you can spend $20,000 per year for your K-12 expense at the lycée, for example. And if you want to learn more about this tax reform, you look at this newsletter at the bottom. On slide 60, at the bottom, you see income. It's to show you that depending on your income, some of those tax provisions may phase out. You may not be able to access those deductions. For example, the SALT I just mentioned, if you make more than $600,000 of adjusted gross income, you cannot use it anymore. Starting $500,000, you cannot use as much of the SALT deduction. So that was for the year 2025. Next slide is for year 2026 on slide 61. Some of those numbers are slightly adjusted with inflation. Another issue is state income tax. You have 8 or 9 states where you don't pay income tax, but you have some states like Illinois where you do pay tax. You have some states like California where you can pay lots of tax. So on slide 63, I put some ideas about how to lower your taxes. One idea is to use some IRA or Roth IRA accounts. You can put $7,000, $8,000 per year, pre or post-tax. Everybody can do Roth IRA, maybe in 2 steps, whatever your income, so that's allowed. Potentially, you can put up to $83,000 in a Roth IRA 1 year. If you are older and if you don't dig a back door in a 401k. And those accounts are nice because you don't have to pay tax on an annual basis. Mutual fund can generate taxes, you don't have to pay those. And when you sell, you don't have capital gains because it's inside an IRA. You have 401k. If you work in the US, many employers offer 401k or Roth 401k or 403b accounts. Pre-tax, you can put $24,000 and potentially $11,000 more depending on your age. The account I like the most is the HSA, the health savings account. You cannot put much, but potentially up to $9,000 that you could remove from your income every year. You can invest, and when you take the money out, there may be no tax, which is nice. Contrary to a 401k, when you take the money out, you may have to pay tax at that time. The HSA are great. Another way to lower your tax is asset location. Another way could be front load tax. Would be a good strategy. Do Roth conversion. You could use a new Trump account that probably be creative and put $5,000 per kid. You can use 5 to 9 accounts. You can put millions of dollars in 5 to 9. You can use municipal bonds for your taxable accounts. So you have many ways to lower your tax. And if you want more tips, you look at the URL at the bottom of slide 63. On page 64, tax planning in retirement is not about minimizing tax in one particular year. The idea is to coordinate what you pay today with what you may owe in the future. The goal is not to lower 1 year. The goal is to lower your tax for the rest of your life. Page 65 are some links, too small. We're not going to talk about it more on some topics related to tax. Page 66, I show that depending on the state you are, you may have some estate tax or inheritance tax, which could be quite high. Like in Illinois, we could go up to 16% estate tax. The tax exemption in Illinois is 4 million. It's not 15 million like on the federal level. Like 67 shows that for the last 100 years, taxes went up at the beginning of the 20th century, but since Kennedy, you can see the trend of taxes going down for individual, corporate, capital gains, or dividends. Taxes are not that bad these days. Another topic on slide 68 is currency risk. For the French in the room or Americans want to retire in Europe. On 69, you can see that the dollar index since 1970 can move a lot. So in the 70s, the dollars went down 30%. Then in the 80s, it went up 90%. And then back down and up and down. And the last, we had a pretty good run since 2008 until, let's say, a year ago. You see it went up 60%. The euro was 1.6, I think, in 2008. And it went down maybe close to 1. Today it would be like 1.16. So you see those movements can affect your retirement asset quite a bit. This chart is just for the dollar versus the euro. It stops in year 2015. I don't have an update, but they use the ECU for the data before 1999. And you can see that the euro in the 70s was as high as 1.7. But then 0.7 in the 80s. So you see the euro can move quite a bit. I've been in the US for 26 years. I've seen the euro at 0.86. I've seen the euro at 1.6. So you have to pay attention to your currency risks. Page 71 as a conclusion. So sticks with you with your plan. Don't try to do market timing. Do not panic. Retirement may be long. Healthcare costs may be high. Inflation, taxes have large negative effects. Capital you may need to retire may be higher than what you expect. Pay attention to asset allocation, diversification. Stocks are good, but they are more volatile. Pay attention to currency risk. Don't forget to file the right tax forms. You have huge penalties. So on the next slide, you optimize your wealth and behavior. You have to diversify, avoid timing, plan for retirement, stay calm, start early. And we started with some quotes, so let's finish with some quotes. Pay attention to what people do, not what they say. I will just read the top left from Warner Brother, who said in the 1920s, who the hell wants to hear actor talk? And you have other examples like this. Maybe you don't pay attention to news. You have to be careful with what you read. With slide 74, I show that in 1979, Business Week had an article, the front page saying the death of equity, Time says the crash, the debt bond. That can be scary, but if you had invested $10,000 in 1979 in US stocks, you see that 10 years later you have 5 times more. That was the 80s. Next slide will show you 90s, same ideas. Time, high anxiety, bankruptcy, sell stock now, apocalypse now. You can look at all those articles, you can find a ton. But $10,000 invested in 1990 will have become $50,000 10 years later. Good. And finally, for the year 2000 to 2009, same idea. 2000 was scary. Bubble warning, fear returns, the end is near. But you see on slide 76, $10,000 invested in 2009 would have become $50,000 10 years later. Thank you. Any questions? Oh, actually, I do have some questions already. So I'm going to read some of those. So French, you are French with French bank account and French properties living in the US. What is the taxation about this? You have to file the FinCEN form 8938 for the account, 8621 for the PFIC. You have to file the form for the SAE. Get tax on your income, on international dividends, capital gains, interest. Second question was about trust taxation if beneficiary lives in France. So it's better to contact a tax attorney because trust can be very different. You can have like revocable, irrevocable, grantor, non-grantor, what type of income, the distribution, how are they made? So trusts are complex, but there is a form, the 2181 in France, Trust 1 and Trust 2, that you may need to file. And if you don't file, you may have a 20,000 euro penalty. Next question was, what are some upcoming events or new guidelines for cross-border payments? Not sure exactly, but in terms of dates, the dates to remember is mid-March. When you have a business, you have to file your return for mid-March. For personal, April 15. You can file an extension to mid-October, but your tax are still owed by mid-April. That's for the US. For France, mid-May, typically. What I'm paying attention is in the US, you have 2 countries in the world, the US and Eritrea, where you are taxed based on your citizenship, called citizen-based taxation. And many people have been fighting for a long time to avoid this citizen-based taxation, which affect, for example, the French. When they go back to France, they don't want to continue to pay US taxes. I had lunch this week with the VP of the Association of Americans resident overseas, and he told me we were never so close to end the citizen-based taxation and to move to residency-based taxation. So there could be some good news in the next few years on this topic. What is the most tax-efficient way to transfer large amount of money, inheritance from and to the US? If you are a US citizen living in the US without a green card, you have your cash here. You can send your cash to France, and there is no tax on that, even if it's not for you. I'm taking, giving money to someone in France. If you look at the tax treaty, the Article 8 of the convention, the French person has to report it, but he should not be taxed on that if you are a US citizen living in the US with US cash. If you have assets in France and you give assets from France to somebody in France, you will have to pay tax on that. Next question, as US citizen, what is the best strategy to reduce taxing due to inheritance received from parents living abroad? There is no tax in the US until you reach $15 million per spouse in a couple. So you could receive $30 million and pay no tax. If your spouse is a US citizen, maybe if you are a US citizen, you could even receive $1 billion and pay no tax. So, but if it's from France, you should not be worried for the first 15 or $30 million for the federal level. But in France, you will have to pay tax. Gas on gifts, you have to remember. That's a much bigger issue. So the tax in the US for estate or inheritance is not a big issue. Another question. Someone who owns a property in France that parents live in. What happens when they pass away? The cash inheritance from parents. So you pay taxes in France. So if you want to reduce those tax in France, what you could do in France is you start to do donation sooner, because if you can do donation in France, like 100,000 euro every 15 years, even more if it's real estate, if you give the new propriété. So by doing donation, you could reduce the estate tax in France. So the sooner you do it, the better, especially if it's real estate, because you have every 10 years, you can live less and less without being taxed in France. If you do not sell this property, I think it's a good idea to do those donations sooner. But if your parents want to give you this property, it may not be a good idea if you decide to sell this property. So on one side, I've just told you start donation soon. Now I'm telling you it's a bad idea to do donation, because if someone give you a house for $100,000 in France today, and you sell it tomorrow for $100,000, and you think there is no tax because you just got the property yesterday and you sell it today at the same price, in the US, this is a wrong assumption. Because if your parents or grandparents bought this place 50 years ago for $10,000, because you receive this property by donation, you have to pay tax on the gains from $10,000 to $90,000, from $10,000 to $100,000. So in general, if you don't plan to keep real estate outside the US, it may not be a good idea to receive donation of real estate. You say thank you. I prefer that I receive the property by inheritance when you die, because in this case you will have a step-up basis. So even if the parents bought the property at 10,000 and you sell it at 100, the day they die, if the property was $100,000, then you have a step up and you have no tax. So you have to think about what type of property it is. Is it like the family house that you will never sell? In this case, sure, do donation to minimize the tax in France. If it's condos that you don't want to take care of, etc., maybe it's better to say thank you. I wait for your death, and I will not have to pay tax on that. The last question I had was most tax efficient way to transfer from and to US. You can transfer money from France to the US. There is no real tax, but the most efficient way is not to use a traditional bank. In terms of tax, it's not an issue, but don't use your typical bank because the exchange rate will be often pretty bad. So you have to use currency brokers online or not, but they tend to have much better exchange rate. Any question in the room? Okay, you are first.
Yeah, so it's one thing to diversify your investments, but are people diversifying vehicles, US brand, for example, or refinement, or pay, US, and else? And do people purposefully both or enhance against, political or
the question is about diversification, US and France, how to diversify. Summary. As a US citizen or green card holder, if you are a US person, which I guess you are, you live here, you work here, having investment outside the US is typically not a good idea, because if you have mutual funds or ETF, tracker in France. This will be considered PFIC, PFIC, Passive Foreign Investment Corporation, and they are taxed very badly in the US. And you have to find an accountant to file the right form and do it correctly, which is hard to find, and they are expensive to pay. So you pay a lot in CPA fees, you pay a lot in taxes, even if you lose money potentially. If you have your €100 investment, because you think you want to diversify this way, so you keep your assurance vie, your compte titre. But if you have 100,000, let's say €100, let's assume it's $100 today, January 1st, and at the end of the year, your €100 is down $10, €90. You don't sell this investment. You think there is no tax? Potentially you're wrong, because it's a PFIC, and PFIC are toxic. Because you have to translate, potentially the CPA will ask you what was the value in dollars on January 1st, maybe $100. What is the value in dollars on December 31st? You're going to say, oh, 105. And what the CPA may do is take the $5 of unrealized gains. So it's not realized gain. So you don't pay 15% capital gains tax. It's not realized, it's unrealized. And you may be paying 50% tax on these unrealized gains, even though you didn't trade and you lost money. So diversification should not be done most of the time using PFIC. So in terms of, so it means you may have currency risk that you should offset by having euro assets in products that are not PFIC. That's one way. Or you buy products in the US that hedge the currency risk. But investing in funds or ETF outside the US, usually I found it not a good idea.
Even if you want to retire with federal usually in US France, you can still have it for getting handle the retirement. That's most in the US.
The question is, if you retire in France, can you keep your account in the US? You can have your 401k. You mentioned 401k. Yes, 401k cannot be closed and it's protected by every law, so you have creditor protection. But when you take money out, it will be taxed because most likely you did a pre-tax 401k contribution. But you could keep it. But the issue is it will be in dollars and you need euros to buy your wine and cheese. Next question, yeah, Thomas.
So the company charge on inflation. So what government economists could involve key rate of
Yeah.
Talk a lot about inflation adjusted income. Profile that's the one today. I think it's not real. This is complicated. So should you be adjusting at 60%?
The question is about slide 18 and the adjustment for inflation. I'm not sure I completely. What you have to understand is your money, if you don't do anything, will buy you less goods over time. You have to remember that inflation could be very high, like in 2022, 23, like in the 70s. And you have one of the goals in your portfolio, maybe should be to beat inflation, because otherwise you cannot buy as much goods and services over the years.
Let's say 0.7%.
The 2.7, yes, what I said, yeah, the word that how economists see the inflation on the slide 18, 2.7%. They calculate the inflation, in this case, the CPI. You have different ways to calculate inflation. CPI is one of the big numbers. There are some people arguing it's a wrong way to look at inflation and what we feel as when we buy goods, etc. You could say that Patrick, I spend much more than 2.7%. Yes, completely correct. Depending who you talk to, but the CPI is a traditional measure of inflation. You had Nicolas?
Yeah, question with what's the three HSA production. So only on the HSA or production. are you then able to, or just put diet plans that for cost, right? So all of it is like
Question is about HSA and the use if you're outside the US. So HSA, you put your money in every year if you have a high deductible health insurance. So you have to make the right election every year with your employer. If you take this high deductible plan, the good news is your premium are lower every year, every month. And you have access to the HSA. And the good news of the HSA, you don't have to keep it in cash, you can invest in funds. So first benefit, you put your $8,000, it's removed from your income. Potentially you save $4,000 in tax every year. Second benefit is you invest in funds for 10, 20, 30 years and they grow tax-free. You don't have receive a 1099 form, so it's good. The question is more about, okay, when we take the money out, if you're in the US, if you have kept your medical receipt during your lifetime, you could take money out of your HSA at 65 years old and buy a Ferrari and not pay any penalties or income tax. If you have had expenses during your life, medical expense during your lifetime, you don't have to have the medical expense at 65 years old to take the money out of the HSA. So that's one rule. And if you have an audit, yes, you have to show that you had those medical expense. If you don't have medical expense at retirement or during your lifetime, when you take money out of the HSA, you will be penalized. You will have to pay income tax on what you take out. But your income tax rate will be much lower at 65, 70, 75 years old than today. So that's three benefits. So it's better than a 401k or IRA. Now, the specific question to come back on that, if you are outside the US, my guess is you should be, I forgot, I think I checked once. My guess is you should be able to show if you have an audit that your medical receipt outside should be able to avoid the income.
But the worst case, pay tax at the
Income tax,
but
yes.
also those like 10% there for what? There's no
To avoid the penalty on withdrawal on HSA, you have to make sure you have had medical expense in your lifetime. And that's why you should keep your medical receipt here and do a scan, because those papers in 10, 20, 50 years, the ink will fade. But just in case you have an audit, it's good to keep those medical receipts so that you avoid any penalties and income tax. Yeah. The penalties is more when you take money out too soon, but at retirement, you're fine. Most people, what they do with HSA, they put money in today, and then during the year or next year, they take the money out to pay for medical expense. That's not optimized. You put money in, you put your 8,000, sure, you get $2,000, $3,000 of tax back. But if you had kept the money there, it could grow much better for a long time without tax. Also, yeah.
That's the idea of the compass for how much to compare to the mayor on age. What we know what you are doing there, I think
So let's go. The question is about slide, let's say, 23, about the chance of success.
Yeah.
50 years, 80%. When you do Monte Carlo simulation, and I'm not an expert on those, in this case, I say do 10,000 simulations. So it's going to do multiple paths of your portfolio. In this case, the top one, I say I want a 4% average return, but you have a standard deviation of 10%. So on an annual basis, it could be minus 10, plus 10. So you're going to have those 10,000 simulations. And we're going to look at your portfolio from when you retire. In this case, it was maybe 65 years old, you retire and you die at 95. 80% means 80% of those lines, of those potential path, will give you more than $0 when you die. 50% means 50% chance that you run out of money before 95 years old. But 50% could be fine for you, because if you see at 85 years old, you start to be below the plan, potentially you can adjust your spending and still make it. So 50%, don't think it's like taking a flight from Chicago to Paris and have a 50% chance to land, because we never take this flight. In this case, you can still make it.
How much you need and height that you start to say, start to I know what the start to say.
You asked about the 1% impact.
The like can you have millions actually say amount per year. The next one I think that
This Monte Carlo or the simple table with
yeah.
The question is,
I think about someone like you said, how much you take per year. But that's okay. I would have another.
this one, how much you save when you start early, you have to save much less.
That's what the one. Or
When two people start at different time? Okay. So we're on slide 29, and the question is, this is the impact of 1% more. So if you start at 25 years old, your career with $47 salary and save 10% per year, if you invest at 5.5%, you may end up with $907 at retirement. First point of the slide, if you don't invest at 5.5, but if you invest at 6.5%, you're going to have $200,000 more.
Okay.
But what was counterintuitive, or you know, the portfolio will last long, but it's really to quantify 1% more performance during lifetime may be equivalent to 12% more life for your portfolio. So don't lose 1 or 2% in fees, in taxes, things like that. Any other question? One more. Yeah.
And you on the US market versus the overall. So think of market like Europe or China.
Question is diversification, US versus Europe and emerging market. Diversification first is stocks versus bonds, let's say. Within stocks, they tend to be all correlated, but you should diversify. So I do believe in diversification within stocks. Maybe 60, 70% US, the rest Europe, Japan, emerging markets. That's a typical portfolio to have 60 to 80% of US stocks and the rest in non-US stocks. But because we may retire in France or retirement in France, we should not have a portfolio like that, because we want to hedge the currency risk. And to hedge that risk, potentially you want more European stocks. So that even if the performance of European stocks is 0, but the euro is up 30%, you make 30% in dollars. So I do believe in diversification, but depending which country you retire, which currency, you have to adjust the stocks allocate the headquarters of the stock, where the stocks really get their cash flow. Because the cash flow of a company will really drive the performance of the stock.
Even if the one for the couple of dollars.
Yes, you can buy European stocks. You buy European stocks in your Schwab account, 100% in European stocks. That will hedge the currency risk. If your European stocks are, if it's a non-hedge fund, you do have some people who hedge this risk. You want the hedging. You don't want people to hedge the fund manager, but you could be buying all the European stocks in the US and hedge this currency risk this way. if you buy individual stock, you have to be careful about that. It's not because you buy Total in France that you have a hedge for the euro currency. You have to look at the underlying cash flows of the company, because the cash flow of the company, the country of those cash flow will drive the future performance of that company. So Total in France, the profits coming from France can be close to zero. So you don't have much French exposure. You may have like some companies in the US, the headquarters is here, but they don't really make money here. So it's not, so you have to think more about where are the revenues, or better, where are the profit of the companies you invest in to really understand your hedging. Start to be more complex now.
But there might be funds or ETFs typically designed for that purpose.
But you can buy a European fund, the Vanguard European fund, so you buy VGK, the ETF, to minimize the tax, and you will have the hedging, quite a good extra hedging for your euros. Yeah. And it's much better than buying the same European funds in France. Because the fees will be higher also, but the tax here and the CPA fees will be too high.
If you have a few minutes, we have 2 questions online.
Question online: does a French citizen need to pay taxes to France while in the US, living and working in the US with a green card? Hold on, keep.
C'est la suite.
But, let me go. So to start the answer, yes, French citizens need to pay taxes to France with a green card while living here, if you have some income, some interest, dividend, it depends on your situation. But yes, a French citizen in the US may pay taxes in France. While working and living in the US but planning to retire in France, it's possible to contribute to the French system for retirement while living in the US. Yes, you could potentially contribute to the French retirement system when you're in the US. If you look at the treaty about that, the benefit, this is one thing that in the US, you may not have to disclose to the IRS. If you earn your French pension, your French Social Security give you a retirement income, usually as a US person, wherever you are in the world, you have to disclose everything to the IRS, meaning your interest, dividend, your income. So Social Security in France, you may think, oh, you have to disclose it to the US. You may pay taxes in France and get a tax credit in the US. But because of this convention, and we have like 3 conventions between US and France, and not all countries have that, very few countries. But it's a good convention because the French pension will only be taxed in France. So you don't have to report it in the US. Would you recommend to focusing on US investment while you were here? Yes, because of the BFIC issue, I think for US person, it tends to be better to invest here. Next question from Jeffrey. What if you live part of the year in France? Do you still pay US taxes primarily as a US citizen, or do you have to pay French tax? Guess what? You may have to pay both US and French tax. And if you are a US person, wherever you're on the planet, you may owe taxes to the US, depending on your income, worldwide, interest, dividend, capital gains. But if you are a French tax resident, which is another topic, and then if you spend 6 months per year in France, most likely you are a French tax resident, but you could be a French tax resident even if you spend 3 months per year. Depends on different criteria, your family, your income, your assets. Any more questions, or we can go for a drink?